All right, just fair warning. Michael is super aggressive tonight. He's got the Cobra Kai schmata on his head. He called me the B word off air. We disagree about the Oscars. We don't have to relitigate that. The important thing is that everyone had fun. Listen, a lot of comments in the chat already. I want to give some shout outs and then we're going to get underway. Rachel Fintwit, we appreciate you. You know we love you. Cliff Peebles, what's up? Always one of the first guys here. Adam Hopkinson, how are you, sir? Riley T. Sandon Presley. Ryan Rose. Vincent Mousseau. Dan Robinson, what's up? All right. We got a lot of people here. That's all I'm going to say. Nicole's mixing it up in the chat. Thanks for your help tonight, Nicole. And the Duncan Hive, I see all the B's. Love to see it. All right. John's here. John's controlling the charts. Okay. The big bounce. This is a bounce that I 100% would not have seen coming. I think it's one of the sharpest bounces after the establishing of a bear market for the NASDAQ, maybe ever. I actually am not 100% sure that I can remember anything quite of this magnitude. Sean shared with me today in prepping me for CNBC that Apple is up 16% in a week, which is its biggest week since 2003. And in 2003, that was a tiny market cap.
I don't believe that that's right. I'm going to take umbrage with this data. Is that really the biggest one since 2003?
I think it's the best week for Apple. It's the best 1 week period for Apple.
Nah,
you don't think so?
Can't be. But, well, I guess it could be. I don't believe that's true. But throw up this Apple chart. What is a fact is it is the biggest market cap change. 11 days ago was the bottom. It's the biggest market cap change over such a short period of time ever.
Okay,
which makes sense.
I'll buy that.
Yeah,
I'll buy that. But I think like what should be obvious to people is that we are just in like a whole new paradigm in terms of the speed with which stocks can fall and then recover. And I know we say it all the time, but I don't know if people really appreciate the extent to which that happens.
We talk about this all the time, and I still don't appreciate it.
I still don't either.
So Chris Sidiel tweeted, he was on the show with us a couple of weeks ago on the Compound and Friends. He tweeted, the S&P's up 11% in 12 trading days. The reflexive dynamic coming from structural flows showing you exactly why it is so powerful and so relevant. If you think this is just dumb retail, that's a straw man's argument for not accepting the environment.
What is he saying? He's saying structural flows, like, meaning what?
Turn this off for a sec. You know all the gamma hedging that was like the big deal with the options and the market makers having to hedge? Like all of this stuff, all this positioning and flows, that is what drives the markets.
Right.
Not in the long term, but like over weeks, days and weeks.
Okay. So in other words, it's like positioning, like another way of saying it is just like the moves that people have to make because of the position that they were already in.
McMurtry talks about this all the time. Tracy Galloway last year, this is a big one. She said pros over flows. I can't remember if that was 21 or 2020. Yeah. That's what it is. And we've been speaking about this, that AAII bulls minus bears chart. Everybody got so offsides. Everybody got so bared up. March 14th was the bottom. I think I wasn't surprised to see a bounce, but I did not anticipate like seeing a bounce this strong.
I'm really glad Y Charts is our sponsor tonight, and the reason why is because we're going to show off a ton of Y Charts right now to go through some of the stuff that's having the biggest bounce as we speak. But let's just mention Y Charts we use in real life to run our practice. We use it to create our content. We're really big fans of it, and if you are somebody that is doing your own research on economics, stocks, bonds, interest rates, whatever, give Y Charts a shot if you haven't already. There's a discount code to register below us.
John, hold on. John, throw that chart, throw that picture back up. See, Josh, you look a lot younger 10 years ago. Throw that picture back up. I was bald 10 years ago, so I look exactly the same. Maybe a little older.
Where?
When
was this picture taken? What's going on with my head?
That's 90 Park. I don't know where you are.
Your bald head is better than whatever I have going on in the front of my head. I'm going to tell you right now. I'm going to tell you straight up. All right. Let us get into the first chart.
I didn't know that this was such a thing. I didn't know this existed. What's in this?
What are we looking at here? Oh, the DSPAC ETF price. Okay. So this is up 14 point. Wait. Where's the distance from the low? I have
No.
it. 19.69% from the low.
Nice.
Yeah. So from March 14th, where this bottomed, like almost everything else we're about to show you, this is a 20% return.
Dude, I forgot WeWork was a publicly traded company.
Yeah. So all of the stocks that de-SPACed, they go into this index, and I don't know how long they get kept in here for, but if you look at the holdings of this particular vehicle, it is hilarious. You're almost like, oh yeah, I remember that. Oh yeah, I remember that. Oh yeah, I remember that. They're all blown to smithereens names, but they had a really big bounce from the March 14th low. What's next?
I'm not impressed by their bounce. I mean, they went down 80%. What is next? Let's go. Let's keep moving.
John's in charge. What are we looking at?
IPO?
No. We're not doing this yet.
What do you mean?
Oh wait, yeah, we are. IPO. Sorry. This one is 27.24% off of its March.
Oh, this is a nice move.
Early March low, March 14th. Again, it's massive. Here's ARK. So ARK is off the lows, 35.6%. So like, if you just bought, all you had to do was buy the bottom in ARK, and you could be done for the year now. That is massive.
You know what was the bottom? Remember that episode where we just threw up all of these charts down 80%? I'm pretty sure that was the bottom.
We put the bottom in.
Good. You're welcome.
That could be. Well, no. Yeah, it could be because it would have been a Tuesday night, which would have been March 13th.
By the way, I'm looking at Apple right now. What I mean.
Wait.
How do you explain this?
Hold on. VGT.
Same thing.
Vanguard Information Technology. This is 15.8% off the low. So this is like not as risky as ARK. But had you bought this at the moment of max pessimism, my God.
Wait, hold on.
What a trade you would have made.
Chart off for a second. I want to pause here for a second. On the show, kind of Compound and Friends last week, which was probably, no offense to anyone else, my favorite episode yet, with Nick Colas. Nick said stocks move for very particular reasons. No disrespect, chart off. I defy Nick to look at this chart of Apple and find a very particular reason.
Do we have it?
No, sorry. No, sorry. Don't worry about it. I'm staring at it. I can't believe it. I
Well,
can't believe it.
I think there are periods of time where stocks move for particular reasons, but then there are periods of time where the volatility of the market, it's like throwing a card deck up in the air and like reshuffling the deck, and it probably doesn't matter what stock you own for a certain moment. XBI.
I think Apple's up 13 straight days.
Yeah. XBI. This is like equal weight biotech index. It's got a lot of the mid caps in here. This is 14.27% off its low from March 14th. A couple more. AMC. This one is up even more, actually. We did the chart too early today. It's 113.56% off its low. AMC.
Next.
GameStop. What did you think I was going to have next?
Whatever. Next.
Wait. 130% off its low. Coinbase, 31% off the low. This thing really does move with Bitcoin. Like, regardless of what your opinion is of the company, this is definitely behaving like a Bitcoin proxy.
I told Ben today, I'm mad I didn't buy Robinhood. I've been talking about this.
We have that.
It stopped going down.
This one's interesting. It never got under 10. I thought it would. Or it spent like 5 minutes there.
It did for a minute.
A minute.
Yeah.
51.64%, including after hours, including today's announcement where they said they're going to extend the amount of trading hours, which we'll see what the regulators say. Short interest in Robinhood, 14.36% of the float, about $650 million worth of short interest. Now, what's price? Put that back up?
$15.90.
So if you stayed short of 10, you could be looking at like 50% loss, and you have a very crowded short there too.
All right, do you have a point? Do you want to make a point, or do you want to keep going through charts?
We're done with the charts. S&P. Let me bottom line this. S&P 4 straight days of gains, 10.19% off the March low. Nasdaq 5 straight days of gains, 15% off the low. Dow is only 7% off the low, didn't go down as much. Russell 3000, 4 days of gains in a row, 9.63%. Meanwhile, While that's going on, bond funds are being crushed. So let's start first. Is this positioning? What are your thoughts? Does the money for stocks coming directly out of bond ETFs as opposed to coming from people's cash balances?
I don't know. I think I'll get there. Stocks went down for a good reason, I thought. I don't know why they're going back up like this.
Well, let's take a look. Maybe this might be a clue. You have to own something, and there are rebalancing trades. Bond funds took in $500 billion last year. Weekly bond flows went negative at the end of February and have not gone positive since. This is the worst peak to trough decline in the global bond market since at least 1990, according to Bloomberg data. Let's put up TLT. Like, whatever, it's 12%, not the end of the world. I'm showing really since like end of January. Not the end of the world, but it's, it's meaningful. IEF down 7.38%. This is people's conservative portion of their portfolio. This is the 7 to 10 year Treasury bond ETF. Barclays Ag down 6.5%. We have that, John. AGG.
John,
Okay,
John, I'm slacking you a chart now. If you get it, throw this up.
All right, and last LQD. Let's get this up. Which one is that? No, that's AGG. Next one.
No. That's LQD.
Oh, we have it.
LQD.
Oh, yeah. This is high yield corporate.
No, just corporate.
This is just corporate.
Yeah.
Which one did we put up? Oh, LQD.
This is LQD.
Yeah. This is still though a 9%.
All right,
a 9%.
It's bad. It's bad. So you're saying that money is coming out of bonds and into stocks. And
I mean, we said that last week joking around, but I actually think that's what's going on.
No, the flows aren't big enough out of bond funds to move stocks like this. They're just not.
They're getting pretty big. $20 billion a week is.
I think that
a lot.
money moving out of bonds is more likely to go into cash than into stocks. I don't think people that are getting wrecked in bonds are being like, "Holy shit, I have to chase the stock market."
No, I will agree. I will agree with that. They're not chasing the overall stock market, but would you be shocked to meet people who sold treasuries and bought Apple and Berkshire Hathaway and stuff?
That doesn't matter.
Chevron?
But that doesn't matter. Would I be shocked to meet people? No. But the money controlling bonds is not selling bonds and rotating into Apple.
Even on a not rotating, rebalancing.
Fine, maybe. But to the extent that it's causing stocks to run, I don't know. But my point was this. All right, so thanks, John. This is Balchuna sent me this chart this morning. These are weekly net flows out of bond funds going back to 2015. It doesn't happen too frequently. We're now, it looks like 3 of the last 4 weeks, it's a lot. It's a lot of money coming out. But
do you see the last time this happened?
2020?
No, besides the pandemic, 2018.
Yeah,
Same
when
thing.
rates were rising.
Right.
So why did stocks start to go down? Well, initially stocks were falling because a lot of these companies were given crappy guidance. Then interest rates started to rise and momentum picked up, and then whatever. Then we got the war in Ukraine, and then we got the inflation, the continued inflation spike, commodity spike. None of that stuff has stopped.
Yeah, true.
But given all of the headwinds and the fact that stocks are rallying as hard as they are, probably tells you all that you need to know about.
Well,
I don't know.
I call this the ultimate fade the news rally, meaning like the big bad first Fed rate hike was March 16th. Stocks bottomed 2 days before. Okay. And actually the gains started to accelerate on the heels of the Fed's press conference.
But given that liquidity continues to come out of the market, that the Fed is going to keep going, that the possibilities for a policy error are larger now than they were, I am having trouble wrapping my arms around this recent move. I really am.
One thing that I think is a very distinct possibility is this furious rally ends at a lower high.
Yeah.
And that's, for obvious reasons, that's tough.
Nicholas said on our show, when the VIX gets to 20, you fade it. The VIX got to 18. The VIX got to 18 today.
18?
18.9. 18.9.
Yeah, so we're through that level.
So by the way, who's to say if we start to roll over again, this could all go away very quickly? I'm not predicting that. I'm just saying.
I guess the question is, maybe we don't need to know in advance, but what is the reason? There's no earnings, and it seems as though there are actual ceasefire discussions happening that both sides are talking about openly.
I guess are people pricing in the rate cut? That seems a bit ridiculous. Are traders thinking that maybe the consumer and the corporation has never had stronger balance sheets, and therefore we've never been better positioned to sustain a slowdown?
It doesn't matter. The yield curve inverted 2 hours ago.
Right.
The clock is now ticking. Even if it's ticking for 24 months, the market basically does not see current Fed policy as being conducive to a growing economy. That's it. Like you don't really need to overthink it the way I always do. I'm going to not do that this time. And actually, I have a call into Campbell Harvey, and we'll see if we can get him on the show.
Did you listen to Joe and Tracy's podcast this week? They had somebody from Macquarie talking about the yield curve.
Vic something or other?
Yeah, something. He said, pay attention to the long end, where the Fed doesn't play, and nobody's bullish on economic growth.
One interesting caveat on the yield curve inversion today. I didn't see anybody else talking about this. Tony Dwyer put something out to Canaccord Genuity clients, and I won't get into the entire thing, but basically he's saying the 2-year is not relevant. That's not the funding market that the banks are in.
What is it,
they're in the 3-month.
Okay.
So he's saying 3-month, 5-year, and actually that's one of the few yield curves that's steepening. And there is such a huge difference between how steep that's getting, 3-month to 5-year Treasury, versus 2 to 10, that the last time we've seen a diversion like that, you have to go back to 1994. And if you do go back to 1994, it's actually not terrible news to see that divergence. So Tony making a point that I hadn't really heard a lot of people making. I don't know if most of our viewers are able to put together a 3-month, 5-year Treasury yield curve chart for themselves. Maybe I should have prepared one, but I thought that was an interesting take.
Whenever the market is saying something that I'm having trouble figuring out, the market is like always right, literally, and I'm always wrong. But I don't get this one. I really don't.
Which one? What I just said?
No, the current, the strength of the balance.
Well,
like we're almost at new highs.
Just look at mortgage rates, and just look at the Great Resignation starting to fade. People are coming back to work, which will help with labor costs and housing prices.
Higher mortgage rates is good for stocks?
No, I'm saying the opposite. I'm saying higher mortgage rates are going to put a top into the housing market, and the housing market and the wealth effect generated by it are a really big part of the rally, and I don't think sustainable from here.
2 more charts, and we'll leave it here. Let's start with this one from Bespoke. The sector 10-day advanced decline line over the past year. Technology is the most overbought that it's been over the last year. LOL. Of course, why not?
This is current? This is right now?
Yeah. And let's look at the ruble. So basically back almost back to where it was prior to the invasion.
Super bullish.
Let's move on.
Somebody has to be on the other side of everything.
Let's do buybacks real quick before we move on.
Yeah. Buybacks are not happening to the degree that you would have expected. This is Savita's group at B of A. Buybacks by corporate clients slowed to their lowest weekly level in 11 months, and on a rolling 4-week average basis are down year over year for the first time since late 2020.
Because look how much they just did.
No, we're gonna have a lower Q1 than what was expected because of the last few weeks. They're saying.
Look at this pink chart from the FT.
It's dated.
How's it dated?
Because it ends in the end of January. So we got off to a bang, but I'm talking about last week's data.
Who cares about last week? Who cares about last week? I'm just saying they bought back a shit ton of stock.
Put back Savita's chart real quick.
John, put back my chart.
No, put back Savita's. I mean, listen, I saw yours, but this is updated further. So I think they were just making the point that buybacks have slowed down to a very, very low pace,
because it went off the chart literally.
And Q1 S&P 500 buyback announcements as a percentage of market cap are 50% below the pre-COVID 5-year average. So I'm surprised. I thought we'd see more. All right, you're up. What do you got next?
Okay. Case Shiller. The month-over-month increase, this is all from Bill McBride at Calculated Risk, was 1.56% month-over-month. The 7th strongest increase since 1975 and stronger than any month during the housing bubble or during the late 70s with high
Tell
inflation.
people what Case-Shiller is. It's the
This
20,
is a 20 city
20
average.
biggest cities.
Yeah.
Yeah. Okay.
All right. So year over year, home prices rose 19.2%. 19.
Crazy.
0.2% with
shit.
mortgage rates are still skyrocketing. But here's the good news. Bill McBride said, actually, before we get there, what's problematic is the amount of buyers and the supply of houses. It's a severe imbalance. Let's look at the scatter plot. So we've got 1.6 months worth of inventory, which this is very intuitive.
The lowest
less
ever.
supply, the stronger the price appreciation. So Bill McBride said that my sense is the Case-Shiller national annual growth rate of 19.98% in August was probably the peak year-over-year growth rate. Gee, I hope so. Last chart before you get to book far. Last chart before you get there. Show. Where's this chart? Did I not put it in here?
No, we have it. Existing home year-over-year inventory. This is Bill McBride's. I put
That's
this
not what
in.
I want.
Well,
you deleted my chart.
All right, I didn't. He's making the point. Inventory will probably be up sometime year over year in the second half of 2022. It's likely that housing inventory bottomed for all time in early 2022. The blue line.
Well, I hope so.
The blue line, which is now up, is year over year change in inventory. So that leads the red line according to calculated risk. So that red line, which is just straight up months of supply, we mentioned it's under 2 months. That's probably going to start popping up in line with the blue line, and the inventory situation should ease and not be as difficult as it is right now.
I've been talking about this on Animal Spirits. Houses in our neighborhood, first of all, there's like none, but the ones that are on the market are...
There's a new one on your block, dude. I'm going to buy it.
Yeah, you see that price?
Yeah.
Ludicrous.
$1.2 million. Kiss my ass.
Every single room needs to be redone, and it's
no disrespect. No disrespect.
Every single... Okay, John, throw this chart up before you get off here. So this is the chart I was talking about. Look at the housing bubble.
That was like a really big deal back then.
First-time home buyers are
though.
so beyond screwed. This is horrible shit. It's really, really... Like, I don't want to say it's a national emergency, but this is really bad.
You have to throw the size of GDP in here or
all right,
or
fine.
something.
I know, but still. It's bad.
But still, you're right. You're right. Bookfar says this is the top for housing prices.
I hope so.
So I'm just. We have his chart, that Bloomberg chart, John. The black and blue. All right, leave that up. What that is S&P CoreLogic Home Price Index. Just another look at that little dip here at the end. He's saying S&P CoreLogic said its January home price 19.2. This is likely the peak in the pace of home price gains. As in January, the 30-year mortgage rate averaged 3.57% versus 4.86% it stood last night. That's the highest mortgage rate in 11 years, guys. So that's not only is it the highest in 11 years, but it got there really fast. Some of the more ridiculous stats: Phoenix, Miami, and Dallas were the fastest growing housing markets by price, up 32.6% year over year, which is just crazy. Peter's been very bearish about this whole thing. Affordability is what he pays attention to, and high prices are not great. Affordability is better, and affordability has continued to deteriorate further, but hopefully that's it. Hopefully we've seen the worst of it.
Well, now the mortgages are becoming like unaffordable, but I don't understand how people, even before the rate increase, where was the down payment coming from?
Their parents. We have data. Their parents. Most of the people that I know, young people that I've seen come in and buy a house, one or both of the parents are helping.
Fine, maybe on Long Island. I don't think nationally it's coming from parents.
Of course. Everything I say is skewed by what I am, but these people's parents are helping them as you know, they should if they can. That's a big part of the American dream. Okay.
We're talking about counterparty risk in this year, 2022.
I'm just telling you, this is a term that we're going to start to hear again. What? It's been dormant for about It's been dormant for about 10 years. Because when a bull market gets late in the game,
long in the tooth,
right? When a bull market gets long in the tooth, or even reverses, we start to see and hear a lot of things that were going on behind the scenes that nobody was particularly paying a lot of attention to.
This was a fat finger or something.
No, it's a little bit worse than that. It's negligence.
It's pure stupidity.
Yeah, no, it's not. Listen, it's not even a trader's fault. It looks like it's a legal error, but I think it's worth discussing.
Okay.
Let me set this up. In the 2007 to 2012 world, anytime you heard counterparty risk or contagion, those two words, the Dow would be down 600 points. I'm just telling you, it's been a million years, but that was a period of time because the number one thing people were worried about was the liquidity. European banks, U.S. banks, investment banks. Who could we trust? What insurance company is about to reveal billions of dollars in losses that they've been hiding, et cetera? We got all these new stress tests, leverage ratios, all the SIFI rules, systemically important financial institutions, and we really haven't had to think about this at all. Bank balance sheets are incredible still, and this has just not been an important thing to worry about. But I think that's going to change here because people are people, and in a bull market, nobody's paying attention to the details. Mm-hmm. So that being said, Barclays issued a lot more structured notes than they were able to based on a shelf registration that they had failed to file. And I think that's just indicative of an environment that's gotten a little bit too loose. The long and the short of it is they registered with the U.S. Securities and Exchange Commission to sell up to $20.8 billion of structured notes. They exceeded that by $15.2 billion. Two quotes. I've seen a lot of structured note issuance, but I've never seen this kind of matter before. Someone else said, it looks like an operational or legal failure. It's hard to believe they would do such a stupid thing. This honestly is the first time I've heard of something. So they overissued and had to buy these things back and take a huge loss. And that actually is going to be a big charge in their earnings. Michael, what are your thoughts?
The Wall Street Journal reported, analysts and investors struggle to make sense of the announcement.
Yeah, crazy.
I think this sounds like a really dumb mistake more than anything. Do you think there's like this never won cockroach type of thing?
It's a $15 billion overissuance of securities, and nobody noticed it until after. It's a $600 million hit. That's like serious money. I know that glosses over us because everyone's talking about trillions these days, but think about how much money that is in a loss for the bank. And the money obviously went to make customers whole. But structured notes make the markets nervous enough because they don't know what it is. So when they hear the term, they think derivatives and they think Adam McKay movies. But to me, that's not a good sign. And Barclays is not a bullshit bank. Barclays, they're pretty serious there. So just throwing that out there. Anything else on this or not really?
I got nothing.
You don't think it's a big deal at all?
No.
When that second cockroach arrives, you might feel differently.
No, I'm not saying it's not a big story, but whatever. All right, next. Let's talk about the paradox of the internet. So Ben Thompson wrote a post that was brought to my attention from George Peleg's blog. Ben Thompson wrote, he wrote this in 2014. He said, one of the great paradoxes for newspapers today is that their financial prospects are inversely correlated to their addressable market. So he said centralization is a second order effect of decentralization. When all constraints on content are removed, more power than ever accrues to the entity that is the preferred choice for navigating that content. Moreover, that power compounds on itself in a virtuous feedback loop, because I think what he's trying to say is that the more content there is, the more overwhelming it becomes. So as everything gets flat, it actually starts to get unflat because people need somebody to aggregate it all for them.
Decentralization leads to centralization in the end. Yeah, listen, I've always felt that is just a trait that's dominant in the history of humanity. It's very rare that there's any sort of power or wealth that's widely decentralized for long. What's more common is large corporations, empires, kingdoms, fiefdoms,
dynasties.
Decentralized experiments like Jonestown and various cults and kibbutzes, and these are the exception. They're not typically the rule. So from a content standpoint, yeah, if everyone can create their own content, that's great. How do you know what to read? Somebody comes along like Packy or like Barry Ritholtz or like Tadas Visconta and says, here are the 15 things that you should actually pay attention to this week, or Mario at the Generalist, whatever. And then all of a sudden, it's not decentralized. It's re-centralized. So I totally agree with this take.
Mario's like, here's this thing that you should pay attention to for 7 hours.
Yeah.
That's what he does. So, all right, Draw wrote, so why do we pick sides instead of trying to process all the relevant information on our own? Because it makes sense. There's too much information to process. The most rational way to function is to pick a side and go with the flow. The human tendency to join groups and run with the crowd is not new, but the internet makes this type of alignment more necessary than ever.
The point he made, this is such an important point that he made about there being shortcuts, because nobody has time to like ask somebody like, what do you believe about everything? So, for example, if you tell me you're against masks, I might say, okay, you're pro-Trump, you have Yosemite Sam mud flaps on your truck, you have bumper stickers about gun rights. Like, I just do that math in my head now. It's totally, like, obviously not the way people really are. There's a lot more nuance.
But it's easy.
But it's easy. And the internet does that, and it's not good.
So
like it's not good.
Elon, which we're about to get to, and we'll end it here. We'll move on to Elon. He did a meme tweet called like the current thing.
He memed, right?
He memed. So Ben Thompson said, and we'll move on from this. Ben Thompson said the internet, thanks to its lack of friction and instant feedback loops, also makes nearly every position but the dominant one untenable. If everyone believes one thing, the cost of believing something else increased dramatically, making the consensus opinion the only viable option. So this is the same dynamic in which publishers become dependent on Google or Facebook or retailers on Amazon, just because that is where the money can be made. And that is like the critical point.
Dude, imagine being like, Putin kind of has a point and tweeting that.
I stand with Russia. What?
Like, right. Like how could you possibly right now? Right. You already know the ostracization that comes from that. Like you're done before you started.
But so
and,
that happens,
the internet does that.
That happens to things much less significant than Russia and Ukraine. It happens everywhere on much smaller scale issues where dissenting, become like ostracized, to your point.
Well, this is why to mock people for meme investing, I don't know if you really want to do that, because a meme is just an image of something that in another time would have been spoken, whispered in people's ears, and would have spread around maybe by telephone. But like markets have always been driven by memes. Now we just have JPEGs instead of like conversations. So they're actually a shortcut to what always happened anyway.
The most dangerous activity in the markets right now is shorting meme stocks. And not like today, just like in general. Although today too.
Right. You could look at valuation of these things, but then you could, the second order thinking is like, well, wait a minute. Everybody gets what the valuation is. That might not be the thing that people are focused on when they're buying this.
Or you could just not short stocks that go up 40% in a day. I just do something else.
I try. I don't belong doing that. Okay, Elon Musk. This would be interesting if he bought Twitter. It doesn't seem like that's really what he's going to do, but just the idea I thought was funny. Let's put his tweet up. So this was titillating to Twitter. Given that Twitter serves as a de facto public town square, failing to adhere to free speech principles fundamentally undermines democracy. What should be done? I think that there is free speech on Twitter, but then there are consequences. Like Twitter's a private corporation. They don't have to host any content that they don't feel like. It's not a public entity. So I think there's free speech, but then you pay a price for it if what you're saying is offensive to enough people. Is that not true?
No, it is true.
And then the second part of that is...
But Twitter is deciding, which is, I guess, I find they're right. They are deciding who to deplatform and who not to.
So I'm going to go out on a limb and say that I think basically what drives Twitter is a mob that's like 2/3 really liberal and then 1/3 extremely reactionary conservative. There's not a lot of people that are neither that are particularly influential in the national debate right now. So it's very loud on both sides.
I'm trying to fill that void.
I think it's very loud on both sides, but I do think like the journalists from Manhattan and Brooklyn and entertainment industry people from LA and then Silicon Valley, they're like really driving the bus. most normal people that I know are not on Twitter, and they only hear about tweets because like it pops up on the news or something. Like most regular people that you know are not sitting on Twitter all day, like share, and they're definitely not sharing.
Do you think 90% of the discourse is driven by journalists?
I think a lot of it. And by the way, it's 19% of U.S. adults are on Twitter. That's the number. But more than that, 95% of the content comes from 25% of the accounts. So 75% of the accounts on Twitter say nothing. So if I tell you it's 19% of U.S. adults, you're talking about 60 million people. And then I'm telling you 75% of them never say a word.
Yeah.
So it's
what's
really...
Elon's point? What's Elon's point?
I think...
What do you mean, what should be done?
Well, what's his point? He's having the time of his life. I mean, this guy literally could send out a tweet and take over the national conversation for 8 hours. I don't know if he has a point. If he buys Twitter, I'll change my mind. But I thought that was interesting. Just that all of a sudden people started thinking, wait a minute, this guy actually has the money to maybe do that if he feels like it. Let's put up these charts. Here's Twitter's market cap, $32 billion. That used to be real money. It is not, in fact, that much money at all right now. There are sports teams that are worth like $5 billion. So taking over the megaphone that moves the world, comparably speaking, is actually pretty cheap. Tesla's market cap. So a stock deal for Twitter, assume a 30% premium, be very, very generous. I'm just saying.
Yeah, a lot of synergies there.
I'm just saying stranger things have happened.
Let's talk about NFTs. We spoke about sports.
I love them.
Relax. So Galloway has a good take. He said, people underestimate the power of brands. It's a lie we tell ourselves. Branded beer tastes better than non-branded beer. Allergy medication is more effective after you watch branded advertisements. Labradoodle versus Lab. So we are tribal species and we sort ourselves with logos. True. So Yuga Labs, Bored Apes raised $450 million. Throw up some of the ape owners. So this is in their deck, which got leaked. Justin Bieber, Serena Williams, Jimmy Fallon, Shaq.
This is the Malone, ape that each one of them owns?
Yeah, Future, Snoop. I don't know what the one on the bottom middle is. Gwyneth Paltrow and Timbaland.
All right, leave this up. There is no question that this is like the spear point of the cultural zeitgeist right now. Like this is it. This is bigger than anything Disney put out in the last year. I would say this is bigger
Steph's
than
ape? Steph isn't even up here. He didn't even make the cut. Steph has an ape.
I don't know, but the FOMO for this is bigger than anything I can remember in like a very long time. People are just like they want to crush their own skulls with a rock if they had the chance to buy one of these and just didn't do it. Look at these people that we're talking about. Shaq is unlimited money. Okay, Bieber is unlimited money. Snoop is unlimited money. So
brands are the most powerful thing in the world.
Yeah, but I'm just making the point. Like most people that are like have that FOMO, I don't think they can afford to buy in and like still be able to live their lives.
Not. The cheapest ape is like $300,000.
Yeah, which really feeds this.
I want to get into some of the numbers that we did. I think we did discuss briefly last week, but throw up like some of the gaming numbers. So games account, this is in their slide. Games accounted for 71% of total app revenue in 2020. iOS generated $47 billion in revenue.
I was surprised by 71. So 71% of the money that Apple makes in its app store comes from games.
Wild. So this is obviously news to you and I. We're boomers when it comes to this sort of stuff. Let's get into their income statement. Another item we discussed briefly last week. These numbers are like mind-blowing. So A16Z led a round of $450 million.
What is this? This is Yuga Labs that created the Ape Coin and Bored Apes and the whole world.
The serum, the mutants. 2021, they did $137 million in revenue for a profit margin of 95%, net margins of 92%, just like literal LOLZ numbers. You've never seen anything like this.
Like the best business I've ever seen in my life.
I mean, just unbelievable. I think the original ape holders got, don't quote me on this, $10,000 in ape coins, which have a market cap of almost $5 billion at this point. So I want to play real quick the thing that they threw on Twitter, which I got excited by. I'm not gonna lie, I get it. Throw up this video.
we don't have the rights to the doors. So that wasn't us playing the music. That's their commercial.
That video was cool.
Okay, this is fair use. We're critiquing the commercial. I think that's the rule.
Who are you talking to?
I don't know any intellectual property attorneys that might be fans of the show. Listen, I don't even know what that is for. Is that a video game or is that buy land in virtual land or something?
They're building a metaverse where you could bring all your NFTs, whatever. I would much
bring them and do. Wait. Finish the sentence. I really don't understand.
So if you have a gutter cat, for example, or an on-chain monkey, shout out to on-chain monkeys. I'm going to Spaces tonight. You can bring your NFT to the Ape metaverse. That's what they're building. And the design and the graphic work, like that's like
wait, but what do I do? So once I go there, what do I do?
You don't do anything. That's some Pixar level shit.
Yeah. No, listen, they're investing. They're clearly investing in like building a whole universe out for people that are interested in this. It's like undeniable that it's becoming immersive.
I am psychotically bullish on NFTs, and I'm definitely not saying that anybody should go out and speculate on NFTs because, yeah, probably most of them are going to zero and whatever. But just this idea of NFTs as a technology, as a community type thing, I think people are going to be foolish to dismiss that so quickly.
All right, Elizabeth Lopato writes for The Verge, and she's, I guess, like a combination of fascinated and skeptical, just generally when I read her stuff, and she's talking about this idea that there is a non-zero chance that somebody will look at the ape coin and decide that it's a security.
Well, what else is it?
Well, that's problematic because it's not being issued as though it's a security with any of the trappings of typical security issuance. But
if this is not a security, I don't know what it is.
Yeah, so maybe they don't care. Maybe they have so much money that they're like, deal with our lawyers. We don't give a shit. And maybe that's how this will resolve itself. But basically, that video that you just showed and the thing that they're building, they're saying is powered by ApeCoin. So does that make ApeCoin a currency?
Dude, I don't want to get bogged down in the details. I'm just saying digital ownership, just like, let's just zoom all the way out. Digital ownership is going to be massive. Massive.
Well, it already is. I mean,
well, not really. No, it's not. NFTs are tiny right now.
NFTs are tiny, but like we've had digital ownership of stuff. MP3s were billions of dollars. People bought music in digital form. It's not new. The NFT format, buying things without dollars, is very new. And to your point, I think it's so early that myself and most people I know who aren't interested in collecting art really have no idea what the point of it might be for them. Because
it's not for them. That's fine. At least not today.
Well, not today.
Most people will say the pet rock, the ether rock going for 300,000. Yeah, all that shit is so dumb.
No. The people that I know who collect things offline are the first people to love this.
Okay. But so people,
like if you're a baseball card person, you get this more than someone who's not.
It's all wash trading. It's all people pumping. Yeah, of course. There's a ton of that. I will not disagree. But digital ownership is going to be 300 times bigger in the future than it is today.
So when does that other side thing open up for the ape people to go and do? I don't know what.
I think sooner than later, actually.
Okay. So that'll obviously be a big cultural moment on the internet. People.
And by the way, I have no interest in that really.
Can you buy fractional Bored Apes or
on Rally you can.
On Rally you can own a piece of an ape. So then who gets to take it for a walk to the multiverse?
I don't know.
To the ape metaverse.
Don't know. But that stuff's pretty cool. I saw that video and I was like, all right, that's pretty sweet.
Yeah. All right. Cool. All right. Viewer topics. Where's Duncan?
Hey guys.
Hey Duncan, how are you?
Doing well.
All right,
Duncan. What are your thoughts? What are your thoughts on the apes?
I think the animation looks really cool. But yeah, I'm kind of like Josh. I guess I'm trying to figure out exactly what they're doing with it. But yeah, like I told you, I mean the animation is legit.
Nobody really knows yet. They don't have to. You know what? It's a lot of stuff. There's a lot of stuff that eventually turns into a video game, and that's perfectly fine. That looks like where a lot of this is headed. Video games are a huge deal.
Huge.
Yeah.
Huge, tens of billions of dollars. All right, let's go.
Also, that's a good time for you to mention winner of Animal Spirits NFTs for No Kid Hungry coming out
tomorrow. We got a good reception on that.
Can you spend a second on that? All right, you're minting NFTs for charity, and they're based on things from your show.
So Duncan, John, Ben, Sean, and I sat down. Duncan, did we have fun?
We did.
We made like 25 different templates or whatever. So if you buy the NFT for 0.1 ETH, that entire 0.1 ETH is going to No Kid Hungry. But you actually get something aside from a snazzy.
0.1 ETH is $300.
Yeah, aside from a snazzy NFT of Ben and I, you get access to, with the NFT, you can log in, like connect your wallet and listen to one live show a month. So you could see us warts and all in real time. You get access to our Google Doc, which is archived all the way back in time to see our show notes. You get access to our Discord, which I will not be involved in, but whatever, you can do that too. You could send us an email. We will answer your question one a month, live from video. And all of this is to raise money for No Kid Hungry.
I love that you're doing that, and I love that it's about like discovering the minting process and the auction, and not doing this like, oh, how can I get people to give me money? You're giving the money away to a really great cause. So I think that's cool.
Yeah, we're
super
sorry.
dope.
Yeah, I think that's the coolest part about all of this is the idea of being able to like give rights or some kind of permissions to people with like it's like a ticket.
It's
at
a
that
ticket.
Point, yeah.
Well, that's the thing I was going to say. This is the real fan club. The 25 people who buy this, assuming a DAO doesn't spring up to just accumulate them all.
25.
How many are you selling?
There's editions of each one.
Oh, I'm sorry. Yeah. Sorry.
Yeah. So there's 25 unique designs, but each one has, I can't remember how many. But
listen, I hope you guys raise millions of dollars. I think it's cool. All right. What's first viewer topic?
Okay. So first up, we have the following. I just accepted an offer to be an investment analyst at an RIA. Getting my CFA was talked about during the interview, but do you recommend getting one? Will it help considering there's so much free info out there now, or is the title more meaningful than the actual education? I know Michael and Ben have talked about this before, but it's been a while, so I wanted to see if they've changed their minds or if Josh had some thoughts to add.
I'm the least educated person in all of financial media, so nobody should take my opinion about this topic that seriously. But the one comment I would make is work backwards. Where do you want to end up on Wall Street? And that will inform whether or not that's going to be valuable to you. So if you say, I want to work at an asset management firm doing research all day, yeah, you probably are going to need that. So this would be a good time to start studying and pursue that. If you say, what I really want to do is be a trader, or what I really want to do is be like client facing as an investment banker and like doing mergers and acquisitions, I don't think that would be necessary at all. In fact, it might distract you from what you should really be doing, which might be an MBA, or might be like the CMT program for technical analysis. Like, you really have to work backwards and ask where you want to end up. What do you think about that, Mike?
Great advice. If you discussed it during the interview, then maybe you should see how badly they want you to get it. Do you need to have a CFA to work at an RA? Probably not. If you want to be at an investment bank and you want to do all that stuff, yeah, you probably need it. And is it like, for me, when I took it, I didn't know anything. I got kicked out of college twice. I had a terrible education.
I remember you studying for it for the second time. I remember.
So I don't regret it. I gave up like years of my life. Every single weekend and every single night I was studying. So it was a lot of work for me because I came in with zero foundation, like literally zero. For me,
do you put that after your title anywhere? I don't think you do. Are you Michael Batnick CFA anywhere?
In my email, I think.
Yeah.
When you were in your email, when you were in Barron's, were they like Michael Batnick CFA or no? No way.
They better have.
No.
No, I don't think so.
No, I don't like
he doesn't introduce himself that way.
No, not to
right.
brag. But anyway,
no, you don't.
No, but
I'm just saying.
But if you really want to be an analyst, then yeah, you should probably do it. I think it's not going to make you a better analyst, but it'll give you a good foundation. You'll learn something.
It does confer. Listen, in the world we live in, this stuff matters. It confers a level of legitimacy on you that maybe other people who are candidates for the same role won't have in their favor. So
I would also say,
on Wall Street, do everything you can to stack the odds in your favor.
I would also say don't like dip your toe because that's not going to work. You can't like half-ass it. So if you're going to commit, then do it. But if you're like on the fence, don't do it. Waste of time.
It's not like buying Bored Apes. You have to actually be diligent about this.
Waste of time.
All right.
Okay.
Viewer topic number 2.
Okay. That first one was from Greg, by the way. So up
Thanks,
next,
Greg.
we have a question next we have a question from Cody, who writes, at what point do Bitcoin doomsdayers admit they're wrong about Bitcoin being worthless or going to zero? Is it a certain price? Does 100K change things?
People never admit they're wrong. The same people that have been bearish on stocks since 2010 are saying the exact same thing today than they were back then. It's going to crash. It's a pond. They're never going to stop.
Wait, who are the Bitcoin doomsdayers?
Chef.
Doomsayers? He
Peter
still
Schiff?
is?
Yeah.
But he bought some. Like he's not
he
unaware of. He never
Did
did?
he?
I thought he.
I don't know.
I'm not in that world. Talib and Rubini.
Rubini.
Yeah.
Who cares?
Maybe they'll be right. It's not over. It's not.
Well,
it's
that's the
not
thing.
over.
They could just say, just wait.
Just wait. Right. How could you say? Maybe they'll be right.
The people that are so passionately anti-Bitcoin, they're never gonna be like, my bad. I'm sorry. I was wrong. Sorry.
I think the bigger issue here, like the better takeaway, is not to like ridicule somebody for their opinion, but the better takeaway for most people, there's no reason to have such extreme opinions publicly because you really can't back away from them ever. It would be very hard to say something's going to 0 and then saying it's going to 100,000. I mean, you can do it, but not if you've been saying 0 for 5 years. It's really hard to back away from very, very extreme opinions, and nobody's paying you to have those opinions. Krugman is a never coin, I think, also, right? Paul Krugman?
Whatever.
Maybe.
But these opinions are what Twitter's made for, though.
In the words of Ronnie Mund, whatever, dude.
Don't paint yourself into a corner publicly. There's no benefit for you. You don't win anything if you end up being right. Nobody really cares.
Hey, are we done?
We're gonna wrap up by thanking people for submitting their viewer topics. Those who do receive a little gift in the mail from us, and we appreciate you guys. Okay, make sure you check out the brand new episode of Animal Spirits tomorrow morning. First thing when you wake up, it'll be on every podcast platform. Thank you guys so much for making the Nicholas Colas podcast episode of The Compound and Friends a smash hit. You guys watch the shit out of that on YouTube. The downloads are going crazy. Nick appreciates it. We appreciate it. We'll have an all-new episode of The Compound and Friends at the end of this week. Have a nice night, everybody.